In this last segment, we're going to talk about two other liabilities you should be aware of: leases and retirement benefits. Operating leases. This is where, when you lease, you show nothing on the balance sheet, but every year all you do is debit rent expense and credit cash for whatever the rent is, or every month or whatever. This is called off-balance sheet financing because nothing shows up on the balance sheet about the lease. But if you do have operating leases, in the footnotes you must disclose your future lease payments on those non-cancelable operating leases. So this is Coca-Cola's non-cancelable minimum operating lease payments for the next few years. That's one way. Now, managers love operating leases because if it's not on the balance sheet, it doesn't impact the ratios. It looks like you don't have as much borrowing or liabilities, so you can improve your credit ratings because you've kept your liabilities, these obligations, these promises to pay in the future, off the balance sheet. In response to that, the Financial Accounting Standards Board said some leases have to be recorded as capital leases, and those capital leases meet any one of the following. And if they meet any one of the following, then when you sign the lease, you have to recognize both a non-current asset called lease asset, and you have to recognize a long-term liability called lease liability, and the amount is its net present value of the lease. As the lease is used every year, you'll have two adjusting journal entries, one for depreciation of that long-term asset, the lease asset, and the second is you have to recognize the interest, and there you impute the interest on that lease liability as it is paid. So that is the difference. So all of a sudden, those leases that were off the balance sheet are now very much on the balance sheet, especially if those leases are as if you own it in this case. So that's leases. Retirement. There's two basic approaches to retirement by companies. One is called a defined contribution plan. It's also known as a profit sharing plan. You may know it as a 401k. If you're in a for-profit business, it's called a 403b. If you're in a not-for-profit business, you can also have a 457. All of these are referring to code sections of the tax code that allows these retirement plans to exist. It's pretty simple. You put away money. You have certain limits that you can put away every year, and so the company debits pension expense and credits cash as an entry every year to fund your retirement plans. There may be matching, there may not be matching. These profit sharing plans are very, very popular. The thing to know about a defined contribution plan is that when you retire, the employee has to pay their post-retirement health care premiums. Also, with a profit-sharing plan, it's up to the employee to determine which of the investment options they want to invest in, and they manage this nest egg of retirement potential. So it's on their head, and many of us tend not to pay attention to what we're invested in and what the market is doing. So it's very, very important, if you have a profit sharing or defined contribution plan, to pay attention to what the market is and what you are invested in, so that you can make the market work for your retirement and not have to work forever. The alternative to this, or it can also be an and, is a defined benefit plan. And these are also known as pension plans. And these are probably the main cause of U.S. companies going bankrupt recently. And the reason is these plans employees generally do not pay into, and the employee takes out a percentage of their highest, they call it the high 5 or the high 7 earning years. So depending upon how many years you work for the company, once you vest, you earn a percentage of your highest year's salary. Social Security is an example of a defined benefit plan as well. To come up with the entry at the end of every year, this entry is usually computed by an actuary, because there's assumptions you must make about how many people are going to stay with the company till they retire, what's the market doing, what kind of return are you getting on the this sum of money that you must then use to fund all these pension benefits. The good news about defined benefit plans, if you have them, generally your employer will also continue to pay your health care premiums post-retirement, and can also pay post-retirement life insurance premiums. Needless to say, besides federal and state governments and large companies such as Coca-Cola that have been around for a long time, these plans, these defined benefit plans, are fading away in favor of defined contribution plans. As far as disclosures and footnotes, this is Coca-Cola. Notice they have to talk about their pension plans. They also have to disclose certain things about their defined contribution plans. And notice, because they acquired the bottlers and the unions with the bottlers, they now also have multi-employer pension plans that were established under collective bargaining agreements. So these are the types of disclosures you'll see. So hopefully you've enjoyed this module on current liabilities and other liabilities too.